Hey everyone! Are you interested in investing but don't know where to start? In this video, we'll be taking a look at the basics of investing, from stocks, bonds, and mutual funds. So sit back, relax and let's get started. Stocks are a form of investment that represents ownership in a public company. When you own stocks, you're a shareholder and have a claim on the company's assets and profits. Stocks can be divided into several categories: common stocks, preferred stocks, convertible stocks, and depositary receipts. Common stocks are the most common type of stocks and offer shareholders voting rights, dividends, and the right to share in a company's profits and assets. Preferred shares offer similar benefits but may have additional preferences such as a higher dividend rate or the right to receive payments before common shareholders in the event of bankruptcy or liquidation. Stocks are a type of investment that represents ownership in a company, while bonds are a type of investment that represents a loan to a company. Stocks typically carry more risk than bonds, but they also have the potential for higher returns. Mutual funds are a type of investment vehicle that allows investors to pool their resources and invest in a variety of securities, including stocks, bonds, and other investments. They are managed by a professional and offer greater diversification than individual stocks. Investing in stocks can offer several potential benefits, including 1. Growth of capital. Shares of a company can increase in value over time, leading to a growth of your capital. It's important to note that stock prices can also go down. So investing in stocks should always be done with an understanding of the risks involved. 2. Dividends. Some stocks pay dividends, which are regular payments made to shareholders based on the company's profits. This income can be a nice addition to your overall investment portfolio. 3. Tax advantages. In some cases, buying and holding stocks for a certain period of time can provide tax advantages. For example, in the United States, capital gains and dividend taxes can be significantly reduced or eliminated if you hold the investments for a certain period of time. 4. Diversification. Investing in a variety of stocks can help diversify your investment portfolio and spread the risk across different sectors and companies. Bonds are debt securities issued by governments, corporations, and other entities. When you buy a bond, you are basically lending money to the issuer, who agrees to pay you interest for a certain period of time, either fixed or variable, and then return your principal when the bond matures. Bonds differ from stocks in a few ways. 1. Bonds pay interest. With bonds, investors receive regular interest payments, whereas, with stocks, the only potential cash flow comes from dividends. 2. Bonds have a fixed maturity date, unlike stocks, which can be bought and sold at any time. Bonds have a maturity date, and investors must hold on to them until they mature to receive their principal back. 3. Bonds are less risky. Because bond investors have a claim on the issuer's assets in the event of default, bonds are generally considered less risky than stocks. Bonds have a fixed interest rate and provide investors with regular and predictable income payments. Bond prices can be impacted by changes in interest rates. When interest rates go up, bond prices typically fall, and when interest rates fall, bond prices typically rise. It's important to diversify your investment portfolio to manage the risks associated with interest rate sensitivity and be prepared to hold your bond investments to maturity when they will be paid back in full along with the final interest payment. Mutual funds are investment vehicles that pool money from many investors to purchase a diversified portfolio of securities, such as stocks, bonds, or other investment assets. By investing in a mutual fund, individuals can gain exposure to a diversified portfolio without having to purchase individual securities directly. This can provide advantages such as diversification, professional management, and liquidity. But it's important to carefully consider the fees and expenses associated with each mutual fund before investing. Additionally, individual securities may offer higher potential returns, but come with greater risks compared to a mutual fund. Investing in mutual funds can offer several potential benefits, including 1. Diversification. By investing in a mutual fund, you can spread your risk across a diversified portfolio, which can help reduce the risk of losses due to a single stock or sector performing poorly. 2. Professional management. Mutual funds are managed by professional investors, who have knowledge and experience in selecting and managing investments, which can help to increase returns. 3. Liquidity. Mutual funds are usually readily bought and sold, making them more liquid than individual securities. However, there are also potential drawbacks to investing in mutual funds, including 1. Cost. Some mutual funds can have high fees and expense ratios that can eat away at your returns. 2. Underperformance. Some mutual funds may underperform their benchmarks or fail to meet their objectives. 3. Limited agency. Investors may not have as much control over the specific investments in their portfolio. As a disclaimer, the information provided is meant for informational purposes only and does not constitute financial advice. Please consult a licensed financial advisor before making any investment decisions. That's all. I hope you gain knowledge from this video.